Welcome, everyone. I'm Seme Herakli, and today we're unpacking a massive, absolutely crucial topic in governance and risk management. We're going to dive deep into the exact mechanics of cash and bank audits. So, if you've ever wanted to understand exactly how an organization protects its absolute financial lifeblood, well, you are definitely in the right place. Let's get started. Take a look at this. This is the complete cash and bank audit framework. What it does is take a highly complex, multi-layered process and breaks it down into actionable, interconnected components. Having a visual map like this is crucial for connecting the dots, and throughout this explainer, we are going to explore every single piece of it. To make sure we don't miss a single detail, we've organized these concepts into 6 logical chapters: fundamentals of the audit, the complete audit process, key risks and controls, process flow examples, checklist and red flags, and finally, the benefits and key takeaway. Chapter 1. Fundamentals of the audit, establishing the what and why. So, what is this, really? By definition, a cash and bank audit involves examining the adequacy and effectiveness of controls over cash and bank activities to ensure that cash is safeguarded, bank transactions are accurate, and records are complete, reliable, and in compliance with policies. But what does that mean in practice? Well, safeguarding cash literally means ensuring the physical vault door isn't left propped open by mistake. And accuracy, that means confirming a $10,000 wire transfer was actually recorded in the system as $10,000, not $100,000. Our core objectives here essentially form a complete safety net. We start off by physically counting the notes to ensure the existence and accuracy of cash and bank balances. Then, we verify the completeness of cash and bank transactions, meaning we check that every single physical receipt from Tuesday actually made it into Tuesday's bank deposit. We also ensure proper authorization and approval, like confirming a director actually signed off on large payments. Next, we evaluate the effectiveness of internal controls. For instance, do vault combinations actually change when a key employee resigns? Ultimately, we do all this to ensure compliance with policies, laws, and banking regulations, and to prevent fraud, errors, and misuse of funds before the money is just lost forever. The scope of the audit dictates exactly where we look, and it perfectly bridges the physical and the digital worlds. On the physical side, we're looking at cash in hand and petty cash, literally looking inside office lockboxes, along with check issuance and payments where we inspect sequential logs. Digitally, we're looking at cash at bank accounts, electronic fund transfers, and analyzing those system logs. We also cover receipts and payments, bank reconciliations, deposits, withdrawals, and adjustments, and we tie that whole shebang together by reviewing the related internal controls and actual supporting documents. Now, within that scope, we zero in on 8 specific friction points, or areas of focus. For cash handling, we review vault access logs. For bank accounts, we mandate authorized signee updates. For receipts management, we verify sequential numbering. And for payments management, we audit the individual payment vouchers. With bank reconciliation, we ensure the person reconciling the account isn't the same person writing the checks. We also focus on electronic transactions by checking dual token security, safeguarding of assets by testing physical security cameras, and compliance and reporting by reviewing regulatory filings. Let's move on to Chapter 2, the complete audit process, the 5-step methodology. This methodology is how we actually execute the audit in the real world. Step 1 is planning, where we understand the processes, policies, and controls and define our scope and objectives. In a corporate environment, this literally means requesting all treasury manuals before we even step on site. Step 2 is risk assessment. We identify risks and control weaknesses and prioritize audit areas, like focusing heavily on the physical cash desk at a retail branch. Step 3 is testing and evaluation. Here we test controls, verify transactions, examine documents, and validate balances by pulling a random sample of cleared checks to physically verify signatures. Step 4 is reporting, where we communicate findings, observations, and recommendations to management in an official memo. Finally, Step 5 is follow-up. We return months later to verify the implementation of action plans and ensure the closure of issues, like checking if they actually bought that upgraded safe they promised. Chapter 3, Key Risks and Controls, Navigating the Friction Points. This is the battlefield, folks. These are the key vulnerabilities that we simply cannot ignore. Some are outright malicious, like cash theft or misappropriation, unauthorized access to cash and bank accounts by, say, a new intern, or forged and unauthorized checks. Other risks are operational failures, right? Think Incorrect or duplicate payments, where you accidentally pay a vendor twice. Delayed or non-bank reconciliation, or incorrect recording of cash and bank transactions. We also hunt for unsupported or incomplete transactions, like a wire transfer with no invoice attached, along with errors in bank charges, interest, or fees. Finally, we look for systemic issues like non-compliance with banking and regulatory requirements and inadequate segregation of duties. But we're not defenseless. To combat those risks, we deploy these key controls. Number 1 is segregation of duties in cash handling and bank activities. John handles the cash, but Mary records it. We demand strict authorization and approval of transactions, requiring a VP's digital signature for large wires. We mandate timely bank reconciliations by an independent person. We ensure secure custody of cash and negotiable instruments using fireproof dual combination safes. We also require pre-numbered checks and proper check control, so missing gaps are glaringly obvious. Add in daily cash and bank position reporting, tight system access controls with a maker-checker mechanism where 2 separate users must release funds, regular surprise cash counts, and finally, compliance monitoring and periodic audits. Together, these make the system incredibly robust. Chapter 4. Process flow examples, real-world scenarios. Let's see how this actually moves. Here's a real-world example of a cash receipt process flow. Step 1, the customer payment happens. Step 2, cash is received and physically counted by the teller. Step 3, a receipt is issued to the client and recorded in the system. Step 4, the deposit is made in the bank, maybe transported safely by an armored car. And Step 5, accounting will record it in the books and reconcile. Our audit focus for this entire life cycle is authorization, accurate recording, timely deposit, receipt control, reconciliation, and the strict safeguarding of cash. Now let's flip it. Here's a bank payment process flow for outgoing money. Step 1 is a payment request. Maybe a department needs new computers. Step 2, review and approval by the department head. Step 3, a check or EFT is issued by accounts payable. Step 4, bank processing. And Step 5, it's recorded in the books and reconciled. For this flow, our audit focus is confirming proper approval, valid documentation, check control, bank statement review, and accurate recording. Moving to Chapter 5, Checklist and Red Flags, Practical Audit Tools. When we are out in the field, this sample checklist is our ultimate baseline. We ensure cash in hand is physically verified. We walk to the safe ourselves. We ensure bank balances are reconciled and reviewed. We check that all cash receipts are supported by actual receipts, tracing daily deposits back to carbon copy books. We confirm all payments are supported by authorized documents, like original vendor invoices. We verify checks are pre-numbered and accounted for, and canceled checks are properly retained, ideally written over in ink. We ensure bank statements are complete and untampered, pulling them straight from the portal. We make sure unusual or large transactions are heavily reviewed. Petty cash is maintained and replenished properly, and access to cash and bank accounts is physically and digitally restricted. And while we're going through that checklist, we are hunting for these common red flags. Frequent adjustments in cash and bank accounts, or unreconciled bank statements for long periods, those are often cover-ups for missing cash. We look for large cash balances not deposited in the bank over a weekend, or missing and unauthorized receipts and payments. We also watch for duplicate or round figure payments, like an exact $5,000 payout instead of a natural varied invoice amount, unjustified checks issued to employees or related parties, altered or tampered bank statements, unusual bank charges or interest expenses, unauthorized transactions or system overrides in the IT logs, and a general lack of supporting documents or approvals. Any of these mean we need to dig deeper immediately. Finally, Chapter 6, Benefits and Key Takeaway, the value add and final conclusion. The ultimate payoff for conducting these rigorous audits is massive. It ensures the accuracy and reliability of cash and bank records, giving investors clean financials. It actively strengthens internal controls and reduces fraud risk. It ensures compliance with policies, laws, and banking regulations, protecting the company from fines. It improves cash management and liquidity visibility for the CFO. It enhances accountability and transparency across the board. It supports management and decision-making, and ultimately, it fiercely safeguards the organization's assets. If you take away just one thing from this entire explainer today, make it this key takeaway. Cash and Bank Audit ensures that cash and bank balances are accurate, transactions are authorized and properly recorded, and internal controls are effective to safeguard the organization's funds. It helps prevent fraud, ensure compliance, and strengthen financial discipline. It all boils down to this profound equation. Remember, strong controls today equals safe cash in banks, plus accurate records, plus compliance. Together, that leads directly to financial integrity and trust. Thank you so much for joining me, Samad Herakli, for this explainer. As you reflect on your own organization's controls, I want to leave you with this. If an auditor walked into your office tomorrow, would your processes stand up to the test, or would they uncover the red flags you've been overlooking?